All right, today we're going to dive into a really powerful signal that you can find on the charts. It's something that can help you, as a trader, spot when a market is just about to turn on a dime.
I mean, it's the million-dollar question, isn't it? You're sitting there, watching a stock climb higher and higher, or maybe it's been dropping all day, and you're just thinking, is this it? Is this the moment it's going to turn around? How do you get ahead of that move?
Well, here's the thing. The clue isn't always some huge, dramatic, explosive candle. In fact, sometimes the most powerful message the market can send you is one of complete and utter quiet, hidden inside one tiny little candlestick.
So let's think about this like a detective story, okay? Every potential trade you're looking at is a case that needs to be solved. And our very first clue is a candlestick that basically just screams, hold on a second. This is where we meet the doji.
So what is a doji? It's actually super simple to spot. It literally just looks like a plus sign or a little cross on your chart. And all it means is that for that particular time period, whether it's a 1-minute chart or an hourly chart, the price opened and it closed at almost the exact same level.
I love this analogy. Think of the market as this constant, relentless tug-of-war. You've got the bulls, the buyers, trying to pull the price up, and you've got the bears, the sellers, yanking it back down. A doji candle? That's what appears when there's a perfect stalemate. For that whole period, neither side could gain any ground. It's a moment of pure indecision, just frozen in time.
But here's the crucial part, and you really gotta get this. A clue is only useful if you find it in the right place. A doji that just appears randomly in the middle of a choppy sideways market, it doesn't mean much. It's the location of the doji that gives it all its power. So when does our little clue suddenly become a huge deal? Well, it's when it shows up at the end of a strong, established trend. If you see a stock that's been on a huge run-up and then, bam, a doji appears, that's a warning sign. It's telling you the buyers might be getting tired. The same thing happens after a steep drop. A doji suggests the sellers are finally running out of steam. And if it happens right at a key support or resistance level, well, that's when you really need to sit up and pay attention.
So the key here is to learn to ignore most dojis. Seriously, most of them are just random market noise. We are only interested in the ones that appear at the climax of a big move. They're the ones that signal that whoever was in charge, the buyers or the sellers, might finally be losing their grip.
Okay, so we found our clue at the scene of the crime, the very end of a trend. But, you know, a good detective never, ever relies on a single piece of evidence. Now comes the important part. We need to gather confirmation to build a really solid case for a reversal.
And if you take away one thing today, please let it be this. This is the most important rule of all. A doji is not a signal to buy or sell. It's not an answer. It's a question mark. It's the market asking, hey, is this trend in trouble? And it's our job to find the answer.
And here's exactly how we find that answer. We're going to look for 3 key pieces of confirming evidence. First, what happens on the very next candle? Second, how many people were actually involved in that tug-of-war? We'll check the volume for that. And third, what are our other technical tools telling us?
So what does this proof actually look like on a chart? First, the candle that comes right after the doji needs to move, and move decisively in the new direction. We also want to see a big spike in volume. Why? Because high volume tells you a real, high-conviction battle just took place. And finally, you can check an indicator like the RSI. It's just a tool that measures momentum, and if it's already showing the market is overbought or oversold, well, that makes a reversal way more likely.
Okay, once we have our initial clue and we've gathered our confirming evidence, our case is looking solid. So now it's time to switch gears from investigator to operator. Let's put together a clear, repeatable plan for actually making the trade.
And you can use this simple framework every single time. It's just 4 steps. 1, you spot the doji at the end of a trend. 2, you wait for and confirm the reversal with more evidence. 3, and this is before you click a single button, you plan the trade. And finally, number 4, you execute that plan with discipline.
Let's make this totally real. Imagine a stock's been falling hard. It forms a doji and you get your confirmation. A solid plan might be to enter a bullish trade. Say, buy a call option as soon as the price breaks above the high of that doji candle. Your stop loss, your safety net, goes just below the doji's low. And then your profit target could be the next area of resistance, making sure your potential reward is at least double what you're risking.
What's so powerful here is that the pattern itself hands you a risk management plan on a silver platter. The high and the low of that doji create this perfectly logical little zone. If the price breaks below that low, hey, your idea was wrong. No big deal. You get out with a small, clearly defined loss. It's really that simple.
Now, you might be wondering, does this work the same on all charts? Well, not exactly. On a faster chart, like a 15-minute, you're going to see these patterns all the time, but they're going to be less reliable. There's just more noise. But as you move up to a 1-hour chart, the signals become much rarer, but when they do show up, they carry a lot more weight and often lead to much bigger moves. So the right time frame for you really just depends on your personal trading style.
Whew. Okay, we've covered a ton of ground. So let's wrap this all up by summarizing the essential tools you need to add to your Market Detectives toolkit.
Okay, let's drill these core principles down. 1. A doji means indecision, period. 2. Context is everything. You're looking for it at the end of a trend. 3. You always wait for confirmation. No exceptions. 4. Plan every single part of your trade in advance. And 5. Always manage your risk. You get these 5 things right and you are well on your way.
And that really brings us to the final takeaway, doesn't it? Spotting the doji is the easy part. It's just the market taking a little breath. The real skill, the thing that separates amateurs from pros, is having the discipline and the patience to wait for the proof before you make your move.